You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few great programs taking up the old archives over there at Volatility Views. This show has many, many archived episodes now. Great guests, debates, discussions, all kinds of fun things. I encourage you to check it out. If you're new to the show or maybe you've joined recently, go hit the archives. Easy place to do that, theoptionsinsider.com, or subscribe to Volatility Views in your provider of choice, iTunes, TuneIn, Stitcher. It's all there. Some of those, be warned, some of those providers may limit you to like the most recent 50 episodes. So if you want to go farther back in that and see some of our other great guests, then you may have to find it via our website or indeed via our mobile app available for iOS, Android, and the Fire OS. Kind of the easiest way to get the full fire hose of data. And of course, however you listen, including those of you who can join us live, welcome every Friday, noon Central, 1 p.m. Eastern via Mixlr, MIXLR. Follow us over there at Options on Twitter or on StockTwits, and you'll see we tweet out the link before the show so you can just grab it and stream live. You don't need a Mixlr account. If you do want to chat with us, you need a Mixlr account. It's free. It takes 2 seconds to set it up. Then you can hit us up with all sorts of great questions and comments, maybe for us or maybe for our guests. We got a great one in store for you today. So we'd love to hear from you guys. Keep those questions coming in, no matter how you listen, even if you don't listen live. Listen after the fact. Hit us up. We love to hear from you guys. And joining me on the old program today, let's go. I don't know where anybody is, so let's just go in order of how they appear on my screen. Let's start with the man coming in from the Option Pit Global HQ, the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com by way of Carmen Line Capital. Mr. Greasy Meatball, welcome back to the program, sir. And where are you today?
I'm in our global headquarters in downtown Chicago. It's great to be here. Boy, it's great to see all this crazy market volatility.
Yeah, it's nuts. so much for the old Trump is not a single-digit VIX president. He might be pushing that pretty soon if he continues on his current trajectory. We'll get to that in a little bit, listeners. But next up on the old program, we have, of course, the man of corner office infamy over there at the SIBO, the head of education at the Options Institute, Mr. Russell Rhodes. Mr. Rhodes, welcome back to the program. Where are you joining us from today? Warsaw, Krakow, Poland, Mexico. Where are you, sir?
The birthplace of the second most knowledgeable volatility guy in the world, Hinsdale, Illinois.
Hinsdale, Illinois.
And that's where, and for those of you that
That's
don't
where
know,
I'm born.
that's where Mark Sebastian grew up. So it's
There we
a
go.
very veiled inside
Veiled-
dig there.
It's
veiled-
it's kind of the VIX hub, if you will.
And it's also birthplace of Morris the Cat, who I think is
Wow.
the most famous
All sorts.
Hinsdalean
Well,
out there. or whatever.
there's a few people from Hinsdale that are famous.
There are, but
The,
they like
the-
their anonymity.
One of the dudes from American Pie.
Yep. D.B. Sweeney lives out here. Who was the guy that won The Apprentice and was
Bill
based in
Rancic.
Chicago?
Yeah, the Rancic.
Yeah,
lived there.
we used to hang out with them until they moved back out to the West Coast.
Oh, geez. I think we'll mute that before we get too deep into the into the famous or perhaps infamous progeny there of Hinsdale. I'll let you two battle it out for who's the more infamous volatility person from Hinsdale. Meanwhile, we're going to keep on rolling because we got a great cast coming up for you right now, listeners, in our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody. That music means it's time for our interview segment, the Volatility Viewpoint, the portion of the show where we bring on guests from throughout the world of volatility trading and academia and research and analysis and fund managers, all kinds of everyone from throughout the world of volatility. We proceed to pick their brains for the benefit of you, the listeners. And today we have a good one. He is Greg King. He is the CEO and founder of Rex ETFs right now, but he also, I think it's also fair to call him the godfather of a couple of products you guys may like to trade quite a bit called VXX and XIV. Greg, welcome to the Volatility Views program.
Hey, thanks for having me, Mark. It's good to be here. Although I got to tell you, they made quite a pitch for Hinsdale, Illinois. I kind of wish I was there.
Hey, there you go. You feel
I'm
left
stuck in
out.
Westport, Connecticut, though.
Feel left out of the
Yeah,
party.
I feel left out.
Well, I'm from Connecticut originally, so we can fight back against them. Nutmeggers versus Hinsdale. I think we win. Many more famous alumni coming out of Connecticut, not just on this show, but everywhere, than there are in Hinsdale, Illinois. But that said, let's get into it. Like I mentioned, Greg, you have a lot of stuff going on right now, and I want to get into those in a second, but we have to start kind of where you started in the volatility space. I don't think there's a week that goes by here on this program where we don't touch on one of your progeny in some way, shape, or form. Of course, I'm talking about VXX and XIV, two products that we get bombarded with questions on a daily basis here on the network and indeed on the show. And people out there clearly love and clearly like to trade, as controversial as some of them might be. So let's just get into that because I know a lot of our listeners want to know. Let's start with maybe the granddaddy of them all, VXX. You were obviously intimately involved with launching that product in the early days. So walk us through that. How did this thing that is now such a juggernaut in the space, how did that come to be?
Yeah, it's a great story. When I was at Barclays, I sort of started off in equity derivatives through structured products with Barclays in London, and in 2004 got moved to the New York office because our team was building up the business there. And part of what my managing director at that time thought would be a good strategy was to team up with iShares, which was a sister company of Barclays, and see if we could figure out ways to tap into their client base. But what happened was we came up with an alternative product structure that wound up getting called the ETN, that we convinced them was a good idea to market alongside their ETFs, because with the ETN technology, essentially, ETNs are bonds technically and not funds. We could do a lot more than you could get done in the ETF world. And so we started off with commodities products, but product number 29 and 30 of the ETNs that we launched was VXX and VXZ. And that just came about basically because people have been clamoring for a VIX ETF for a couple of years, really. And every time we went back to our traders and our risk people and stuff, they said, well, the futures market is just not able to support it. But eventually it got to the point where they were willing to kind of let us do that. And so VXX and VXZ were launched. And there's an interesting story in between kind of why we launched both of those as well. For those of you who keep track of this kind of thing, those products were launched in January of 2009, which was right after Barclays and Lehman got together. I don't know what you call that. It wasn't a merger, but when Lehman got essentially went bankrupt, and all the guys came over kind of like the next day, basically, and Barclays bought the building.
A forcible merger, if you will.
Yeah, I don't know what you call that, like a head fake and then hire everybody or what. But we were over on, I was Legacy Barclays, so we teamed up with the Lehman guys and kind of got to know each other, like who's doing what, and this is sort of 2.5 years into the ETN space, right? In June of 2006 is when we launched the first ETN, which was the first ETN anybody launched. So Jan of 2009, 2.5 years later, we had been working on what became VXX. Well, it turns out the Lehman guys have been working on what became VXZ, which is, of course, the product that's out in the latter part of the curve. And we each had reasons why we thought that, the one was better than the other. And ultimately we realized, hey, we don't have to argue about this. Let's just launch them both and kind of see what happens. And, it was the typical trade-off of, well, this one's going to, decay faster, but give you more bang for your buck, that being the VXX product. And the VXZ, will have less sort of decay. Advisors might be willing to hold that longer term in portfolios. And so we launched them both and just kind of let the market decide which they like better.
Now, obviously, this thing has been pretty much a home run almost from the moment it was launched. And you just mentioned the erosion factor there. We talk about that a lot on this program. It's one of the few reliable factors in the marketplace these days, that inevitable erosion of VXX. You mentioned sounds like you obviously were aware of it when you were designing it. It's a fundamental concept of the product. But were you ever scared that factor would really maybe drive people away from it? And did you ever imagine in a million years that a product like this that erodes so quickly, that is really only suitable for kind of short intraday type trading and maybe a little bit longer if you're really careful, that anything like that would ever really, I think, capture the mind share, including of the retail public, the way it has now all these years later?
Yeah, no, I don't think we envisioned the success that it has had. I mean, we certainly thought that there was some demand out there, but it was mainly from sophisticated investors. They wanted a hedging vehicle. What people ultimately we thought wanted, who were interested in this, was like, VIX is at 12 and goes to 16. My ETF is at 12 and goes to 16, right? Just something to track spot VIX. And that was part of the debate of do we want to do this? Are people going to understand the difference between the spot movements and the, I guess the summation of all the futures movements. And so, we did it, but it was with sophisticated investors in mind. So it certainly didn't anticipate, I think, the kind of widespread interest in it. And the whole complex has obviously grown since then with other entrants and other products coming online. But yeah, we were aware of the decay aspect, and but you had the like oil ETFs of the world out there and nat gas and so on. So we felt like people were at least generally familiar with this contango backwardation type of aspect that comes into play with any futures based type exposure. So we put it out there. We put a lot of disclosure in the documentation that was, generally making people aware of who should invest in this and who should not. And it did meet with a lot of success pretty quickly.
Now, I kind of mentioned that controversial aspect of it. And it's controversial for a reason, because as popular as it is, like we mentioned, it erodes very quickly. And we've seen a lot of people, using this product and really adopting the wrong use case for it, particularly out there in the retail public. They've come on board, they've learned about volatility. Maybe they watch a CNBC, they pick up a financial paper and they hear about the fear gauge. It sounds really cool. They see VXX as a popular vehicle that trades it. And next thing you know, they're buying and holding this thing in their IRA, which is about as the most polar opposite of the way you should be trading this thing as it possibly could be. How does that strike you guys as the creators of this? Obviously it's popular. You want your product to resonate out there with the audience, but does it also maybe give you some pause that there's a lot of people out there who maybe shouldn't be using this? What is your take on that? Or you think at the end of the day, it kind of all evens out in the bathwater there?
Yeah, great question. I got to say, so first of all, obviously I don't work for Barclays anymore. I haven't for 8 years. So, and the product's still out there. So I got to be a little careful. I mean, my own personal opinion is that I think that the ETF or ETP market is pretty well how shall I put this? Regulated is the wrong word, but pretty well supervised these days. And what you have is brokers who have implemented a series of kind of like constraints. So, for example, some of the really big wirehouses, they just flat out don't allow VIX type products to be traded within their system. So if you got an account at XYZ, wirehouse, you just can't trade the stuff. And then down to the discount brokers, they'll put in something where you have to essentially, warning signal, you need to understand the risks, et cetera, et cetera. And if you sign off on that, then, it's sort of on the investor to kind of do their due diligence, et cetera. So generally, I think that we always had the view that our responsibility was to create a responsible product to provide, all the disclosure that we needed to, but ultimately you can't control what people are doing out there. And the people who are best positioned to do that is basically where they hold their brokerage account, their broker.
So, I got a question for you. Having built this product that is successful, why do you think that, so many groups try to launch ETNs that try and solve the VXX problem, or ETNs that do a different, or ETFs that take a different approach? Why hasn't anybody been able to do it? And have you seen any products that you think, I don't want to say are better, but do a decent job of solving some of the issues that VXX has?
Yeah, great question. That's I didn't plant that question. It's a bit of a softball because it leads to our products, my Rex products, the ETFs that we've got out there. But just to talk more generally. So first of all, we know obviously that the decay factor comes from the fact that you're long volatility. There's no free lunch, and what comes from that potential asymmetric return, right? It can only spike up. If you're sitting at VIX of 10, it's not going to spike to negative 10, but it could spike to positive 30. So in that position and with time value, we know that that's going to cost money. So ultimately, it's an unsolvable problem to the extent that people are trying to deliver something that's just reflective of spot VIX, forever without a cost. But I do think it's still a imaginary sort of holy grail. What I think is doable is getting closer and getting a little tighter with it, and that's what we try and do with our current ETFs. It's basically not rocket science, but the weekly contracts came out, and if you take the general index, S&P short-term VIX index, it's got a duration or a weighted average time to expire of the futures in the index of around 33 days. And, SIBO's got some great research that shows, the curve and how it asymptotes up towards a beta of 1 as you get to 0 days to expiry, right? So if you can just reduce the number of days in the duration of your exposure, you're going to get a closer exposure to spot VIX without using leverage. And so that's basically what we've tried to do with the Rex ETFs, VMAX and VMIN, is just use a proportion of weeklies, get that duration down, and give people a little closer to the spot VIX exposure without taking on leverage.
Now, I want to get into your Rex-Shear stuff in a minute, but before we get to that, I'd be remiss. A lot of people are hitting me up, too. They want to know about your other product you created. So we're going to live in the past a little bit longer before we get into the present, if you bear with me here, because it's another popular one. You're cursed with having two popular progeny in your coming out behind you, of course. After VXX, you went on to be instrumental in helping to create XIV. Of course, a lot of our listeners know that one as well. And if we mention VXX on the show, chances are XIV is somewhere in that same conversation, not that long thereafter. So same question, really, we can really quickly kind of walk us through the origins of that one and why, what prompted you to want to go to the dark side this time with this product. And again, another one where you kind of think when you launch it, it's a bit of an esoteric thing, an inverse VIX ETP product, and yet another one that has probably resonated maybe beyond your wildest expectations when you first launched it out there. So walk us through kind of the early days there of XIV.
Sure. So actually, we went. A friend and I who worked together at Barclays, and another guy started Velocity Shares in early '09, and this VIX thing was taking off with Barclays. We thought we could do some more of that, more commodities products, and essentially partner with a different bank. So we partnered with Credit Suisse, and this whole decay element was front and center, and everyone's sort of saying, "Hey, well, these things bleed so quickly," and it was kind of an obvious next step. Well, why not launch a short product that essentially takes advantage of that and has the reverse exposure? So XIV came about, I think, in late 2010. And yeah, I mean, again, that one is definitely more popular than I think we anticipated. And I think that's just because of the returns. I mean, I don't have them in front of me. You guys would probably be following this more closely, but I mean, XIV is up materially since its launch. And, aside from the major downdrafts, which do happen, it's a pretty steady climber apart from that. I mean, which makes sense, right? It's got the kind of opposite, not symmetrical, but generally the opposite stance of VIX. And if you think about a VIX chart and what it looks like, it kind of bubbles along at the bottom, and then there's these spikes. Well, these short products are the reverse. They kind of tend to accrue, and then downdraft, and then start accruing again. So that was really the thought process behind XIV, and I think that took a little bit longer to get going, but not that long. And one question that leads to, which I don't have the answer to, but get asked all the time, is what are people net long or net short volatility using all these ETPs? And I think people are tempted to sort of just look at the notionals or look at the AUMs and kind of net them out, et cetera. But I'm not sure that there's an easy way to track the amount of VXX that's held short. So clearly the short side is a popular trade, and I don't think anybody truly knows exactly what proportion is held net long or net short at any given time.
This is Russell. I think one of the things with respect to VXX in trying to figure out exactly how it's being used, so much option activity goes on there that in fact, I know that there's a pretty successful strategy where you constantly own VXX, but you're always selling calls because of the way the funny skew works, and you really can you can outdo that contango grind by just selling out of the money calls. So, what are those people actually doing? They're really trying to take advantage of, or they really don't want a big spike in VXX, even though they own the fund. So I agree. It's pretty tough to pin down exactly how they're being used, especially for anybody that holds them for more than a day.
Right. Yeah.
Yeah, that is that's a challenge. But you're right, especially with these short products, these inverse products like the XIV, it is a little bit of a question mark. Getting into that short area for a second too, before we get in to the new stuff really quick. This is another area you're kind of spearheading interesting new areas that also maybe come with a little bit of controversy attached to them as well. We've seen a lot of people writing up towards look at how great short vol was in 2016, and a lot of people are coming into this space now. They're attracted to the idea. Clearly, it's worked out well for the beginning of 2017 either. So maybe I'm being a worrywart for nothing, but it is kind of interesting to see so many people flocking into these products who are, again, if you had told them in the inception you're going to have this product that is the implied volatility of another derivative, then you're going to have an inverse product on that. It can get a little obtuse for some of these people, a little arcane, and yet they're flocking into them. Are you, again, does that interest you, or is that maybe something you think of as now having created these products that so many people are flocking into the short end of the curve, again, without maybe realizing, exactly what the heck they're diving into? It's an interesting area that, we haven't really seen people consider a lot until this VIX ETP universe has just exploded. And now we have so many different flavors. And it kind of does raise the question of, what are these people getting into? Do they know what they're getting into? And maybe, who knows, is all this short VIX trading, is that an interesting path to go on? You, as the creator of it, what are your thoughts on that?
Yeah. Well, creator of short VIX is maybe an overstatement.
XIV. We'll leave it. Just limit it to XIV.
Yeah. Okay. All right. Look, I mean, 2016 was a huge year for this strategy, and I know that's attracted a ton of attention. I think the challenge is that we have free markets, or let's call them free-ish, right? And so the people that we wind up talking to, the advisors and the people who call in or that we're in touch with, I mean, they want to understand these strategies, and they do want to know, okay, what can go wrong here? What should I be looking for, and all that kind of stuff. And we try to educate them. I do think obviously there's an element of out there that doesn't call in and doesn't try and talk to anyone, maybe doing self-education. But ultimately, I think that it's right now in February of 2017, it's extremely topical just because of the performance in 2016. I've seen it get hot before and fade back away, and people are less talking about it. I really do think that the attention is driven by this 2016 performance, but also what's been going on lately. You guys were talking about right at the beginning, with Trump in office and VIX ultimately still very, very low, right? So I think it's a bit counterintuitive as well as to what's been happening lately. So people are just, not getting it in terms of why does this keep persisting? Hey, is this going to last for a long time?
Well, I could keep going on about VXX and XIV for a long time. I know a lot of our listeners would like that as well. But, you're obviously doing new stuff now, which I want to get to as well. Of course, you mentioned RexShares at the top of the show here. This is your new venture. You're the CEO and founder over there of RexShares, and you have some interesting new products. Why don't you walk us through your new launches over there at RexShares? Because you weren't done with the volatility space. You had to dive back into the fray now with VMAX and VMIN. So walk us through what we're getting there with VMAX and VMIN.
Yeah, sure. Thanks. So this really came about, was facilitated by the launch of the weekly futures. I guess that would have been August of 15. We started researching. We were working on some other ETFs. Just to take a step back in terms of my own career, we set up Velocity Shares, and then Velocity Shares was sold to Janus Capital in 2014. So I figured out, having to work for a couple of big banks and then one startup, I figured out I'm an entrepreneur at heart. So I wanted to do this again and kind of keep going. But we moved with RexShares. We decided to focus on ETFs. ETNs are sort of my entree into the space. But I've worked with them for 10 or 12 years, and ultimately an ETN is a note issued by a bank, and there is just a whole swath of people out there for whatever reason, whether it's investment policies or what have you, that just can't trade ETNs. So we wanted to use the ETF structure and continue to innovate, and ultimately we're derivatives guys, so everything, and frankly there's 2,000 ETFs out there, right? So a lot of good ideas are gone. If you want to be successful, we think you have to come up with something that solves a legitimate problem for investors, even if it's really niche-y. So you throw all that together, and we were working on some derivatives-based ETFs and saw the opportunity to create something that had a lower duration that was very similar to kind of the benchmark index, the VIX short-term rolling index, but rolling the weeklies. And so what VMAX and VMIN are is just the long and the short of VIX futures exposure. The thing is that in the basket, we have a portion of it in VIX weeklies at any given time, and then a portion in the monthlies. And that's a function of a number of things, not the least of which is the liquidity, which isn't quite there yet with the weekly VIX futures. But the overall concept is really straightforward. It's just get half the distance to the goal. If with the monthly index, you're at the 10-yard line, we're trying to get our average exposure to the 5-yard line. The touchdown being perfect tracking of spot VIX, which ain't going to happen, right? So we've gotten closer in terms of a lower duration than any other product out there. And we don't have this, I know there's been other products that have a kind of a dual trust structure and one thing pays the other. Ours are just straightforward ETFs. They hold other ETPs, like we do have to hold some of the ETNs just to get that exposure up, and they hold VIX futures, or long or short, and that's it. So really the two firsts these are the first what we call 40 Act ETFs. That means you have an actual fund with an actual fund manager, and they are the first to get less duration than monthly. So the VMIN, our short product, is the one that everyone wants to know more about at the moment, because year to date it's up something like 44%, and we launched it in May of last year. It was up 81% just in those 8 months or whatever. So it's definitely topical, and we're getting a lot of calls on that one. Not so much on the VMAX side, because that has even more decay than kind of your monthly products at the moment. But back to your question on short VIX, it's definitely topical.
Yeah, speaking of topical, we did put out a little live poll here right when we started talking about have people pick their preferred VIX poison. We give them VXX versus XIV, facing off two of your progeny there versus some others. And so far, VXX winning 43%, 29% to XIV. We'll see how that shapes up as the rest of the show progresses here. But you mentioned, what you're working on now. This, we've heard a lot of people tilting at this windmill. It is very much, if there's a holy grail right now in the volatility space, it is this. It is attempting to somehow replicate, that cash, that spot VIX. It's still to this day. We've been doing this show for how many years? We've had this network for 10 years now. We've been running the site for that long. We've been hitting on this topic so many times. We think we're blue in the face, and still to this day, the number one or number two question we get in any given day or week is going to be, hey, I'm looking at VIX options. The cash is here. How come these options are so mispriced? They don't understand that it's an option on the future. They're not trading the cash index. They want to just trade that fair index. They don't want any of the other minutia that goes along with it. So something that could deliver that is obviously a very hot thing. Like I say, the holy grail of the volatility space. Now, as you mentioned, we've seen other players attempt to do this very recently. Of course, most infamously recently, the Whaley product, which started off really attempting to deliver something else and then ended up coming in to try to deliver this spot VIX type tracking performance. As you also mentioned, and we've talked about on the show, that one, shall we say, a little complex. We broke it down once live on the show, and I don't think any of us could really make heads or tails of the various counterparties and the distributions and redistributions and rebalancings that were going on an almost second-by-second basis. I think to call it obtuse is generous. So it's obviously a challenge. You guys are obviously now competing in this space. How are you attempting? You touched on it a little bit, but just to go a little bit more into detail. How are you guys really, attempting to deliver this holy grail without the complexity that I think it's fair to say bogged down the Whaley version?
Yeah. Okay. Well, just to be clear, we're admitting that we're not going to be delivering the holy grail, and I think that's a key point, right? Because I know others have been out there saying, "Hey, we are going to deliver this holy grail," right? But if you just think about any relationship of a future position to a spot position, the longer term the future, generally, the less it's going to behave like spot, right? So it's like a kite, the tail of a kite, flapping in the wind or whatever. Our tail is just shorter. We're just seeking to get an exposure to VIX via futures that is on average shorter than the benchmark index products that are out there. I can't talk about our current products, by the way, versus other products. So I'm just going to talk about the benchmark index, the general S&P VIX short-term index, which, I mentioned is like 33-day exposure on average. Our funds are in the sort of high teens in terms of the average days to expiry. So if you imagine that we had, and this is just purely hypothetical, but if you imagine that we had a VIX futures position that was on average 5 days to expiry, right? Clearly, that is on a overall basis generally going to track the movements in spot VIX a lot more closely than something that's 30 days out in terms of the beta of the exposure. So we're just trying to get up that curve. We're admitting we're not going to get there, right? We're never going to have a spot VIX product. But that was all the way back to VXX. That was the debate is, hey, we're going to have this product that has some kind of basis, some kind of tracking is the wrong word. People like to throw that around, but that's not the right word. but some kind of noise in its performance vis-a-vis Spot VIX. Do we really want to launch that? Is that going to be okay? Turns out it was okay, and people, most people hopefully do understand that, and it's still popular. We're just trying to reduce that noise here with these new products and say we're getting in kind of half the distance, roughly speaking. It moves around from what the existing benchmark is to spot versus what our funds are to spot, and hopefully that appeals to some people. On the long side, I guess the best way to say it would be the goal would be bigger bang for your buck in terms of the performance, but without leveraging up. Right. So on the short side, we have seen that our funds outperform so far, anyways, the benchmark index, and the opposite on the long side. Does that make it more clear? So not Holy Grail, but
Yeah, I got you. Definitely aiming for the Holy Grail, but obviously that's a very difficult benchmark to achieve. But yeah, I think everyone out there is trying to aim for that, and the closer anyone can get, obviously, the better it is for the product, better it is for people who want to trade it. So that's a good goal to have out there, even if it is, shall we say, a challenging one to hit. Russell, I know you're chomping at the bit to have that Greg here, sir, so go for it.
Wait. No, just, Greg, I know that you guys are targeting and doing a good job of having a shorter duration than 30 days. If we do our job over at CBOE and we can get the liquidity of the weeklies up, do you think that your duration number is going to continue to come down?
I wish I had my lawyer here. He could tell me whether I can answer that question or not. But
well, it seems to me. Well, you know what? Don't answer it, and I'll say it.
I'll tell you what. One of the biggest impediments to the growth of our funds right now, I think, is the bid-offer spreads, which are a function of the underlying weeklies. Because when we see those spreads come in, trades start happening, and when we see them widen out, they don't. And I know we've got a lot of eyeballs on those products versus the current size and trading volume. So if you were able to at CBOE wave a magic wand and create the depth of liquidity, or anywhere close to, frankly, that you have in the monthlies and in all the weeklies, I think that you may get some additional business from the Rex Shares funds. Yes.
Okay, I'll get on it.
There you go, Russell. Employ that magic wand of yours. But that is an interesting point. Maybe one worth elaborating a little bit more. You guys obviously just touched on it a bit, but people are used to a product kind of attempting or delivering this kind of sort of a standard duration product. Here's your 30-day product. Here's your 1 week product, whatever it may be. These new VMAX, VMIN, it's going to vary, kind of like we just said, and it's a bit of a target goal. I think the target is anywhere from 5 days all the way out to 29 days on the longer end. I don't think you want to be out that far, but I guess it could happen depending on the curve and the liquidity and things like that. But I'm assuming, Greg, from talking to you and hearing your things, your target goal is it fair to say somewhere around a week to 2 weeks, somewhere in that range?
Yeah. So on our website, we've got the what we call the duration chart, and it does move around. We try and keep it pretty constant. We don't want to surprise anybody. I think over time we like that to see that go down, but we're trying not to to jerk that around a lot. It is, like I say, a bit of a function of execution in the underlying market and so on. But yeah, it's sort of been in the high teens, 18, 20, that kind of thing. But one aspect is a bit technical, but so our funds are technically active funds, which means they don't actually have an index that they track. So our stated objective, if you take VMIN, for example, in the prospectus, and I'm probably not quoting this perfectly, so everybody go and download the prospectus and all that good stuff. But it's essentially that we will maintain a target of 100% short exposure to VIX with a less than 30-day duration at all times. And so that does give us some flexibility, but our duration has averaged kind of 18 to 20-ish, and we put that up on the website so everybody's aware of it on a daily basis, the holdings, and hopefully there's no surprises. But we would like to see that lower over time.
I think it's just a function of what we were talking about earlier with Russell and maybe some of the liquidity issues and everything else. And it still is a new product, so I think there's a bit of a feeling out period that has to be done. But yeah, that'll be interesting to see how this actively managed product, what kind of duration it ends up settling around, which I think will be interesting to a lot of our listeners who are, you wouldn't believe the number of emails we get and tweets and everything else, Greg, saying, hey, how come I can't trade anything that closely approximates even the cash VIX? So again, the closer you get to that, I think the more excited people will be. Well, Greg, we've taken up a lot of your time here on the program, but I appreciate you joining us. Like I said, we probably could go on for quite some time. I'm sure our listeners have a bunch of questions they want to get to us. Maybe we'll have you on again down the road to answer some of those questions. But before we go, is there anything, obviously you have a lot of products coming out now, the VMAX and VMIN. So if our listeners are interested in these, they want to learn more, maybe even trade them for themselves, where should they go? What should they do?
Sure. So we call these products, we put a brand on them of Volmax, VOLMAXX. So if you go to volmax.com, you can find all the product information. We put our actual, office number on there. Feel free to give us a call, and we'd love to talk to you. And yeah, keep an eye out. We think there's a lot of cool ideas to still be done as funds in the volatility space. So love to talk to whoever's interested. Thanks for having me on. Really enjoyed it. I didn't realize we'd already been chatting for 42 minutes.
Yeah, it's crazy.
It's a lot of fun.
Time flies when you're talking VXX and XIV and Spot VIX and all the other fun stuff and duration. So yeah, we appreciate having you on, and we're looking forward.
We just scratched the surface.
Yeah, exactly. Yeah, we did. We could probably go for another couple hours. I'm sure there's people in the chat room who want us to keep going, but we got to wrap it up. Unfortunately, got to get going with the show. But Greg, we appreciate having you on. We're looking forward to having you on again to kind of talk about how these products are unfolding in the marketplace, how that evolution evolves, how that duration evolves, and how that liquidity in the futures also impacts them as well. So we're looking forward to that. And check them out over there if you want to learn more for yourselves. All right, but we have to keep rolling with the program right on into abbreviated volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Volatility Review, the portion of the show we break down the week that was from a volatility trading and analysis and trending perspective. It was a great chat about all things VXX. I'm sure you guys will have questions. Hit us up if you do indeed have that. Of course, interesting week. VIX volatility continuing to erode. We joked on the show last week that I think it was you, Russell, said Trump ain't 12 VIX president. Well, so far he's not. You're right. That's way high. He's far beyond that. My prediction, I got to say, looking a little prescient at the start of the show. VIX rallying a little bit, so we'll see if it rallies to where the greasy meatball is, or if I will be the winner. But so far, at least, looking pretty good on that. I think I was 10.5, somewhere in that range. But yeah, most of the major indices are rallying a bit today, up about 0.5% or so, and VIX cash continuing its inexorable decline to the downside. VVIX also slumping a little bit down in the 85 range after spiking, obviously, into the hundreds not that long ago. But these days, well on the low end of that. Also, the skew index coming off quite a bit today, off about 4 or 5 handles. That's about 3.5% or so. That's about right around 129. That's, of course, off of its recent high, about a 6-month high, actually. It's set back on, surprise, surprise of all days, January 20th. I wonder what could have been happening that day, why there'd be so much bid to those puts and offered to those calls out there. But c'est la vie. Interesting stuff cooking out there. Let's get into it. Let's start with you, Mr. Greasy Meatball. What's been catching your eye this week from a volatility trading and trending perspective?
Well, let's talk about realized volatility right now, okay?
What is that? I don't see any of it right now. So
exactly. So in 10-day realized volatility is less than 6%. 20-day volatility is about 6.1%. 30-day volatility, 6.6. 60-day volatility, 6.8. You have to go all the way out to 90-day historical volatility to get something that even approaches 8%. So when I look at a VIX of 1077, I'm looking at a VIX that's extremely overpriced and maybe does call for a single digit here. I have been just shocked at the total lack of movement in the market. I think we've gone 50, 55 days since we had a 1% move. And then the other big thing I'm watching is the futures curve, where as I look at it, when we come in on Monday, all other things being equal, the VIX will be 11.4, okay? And with about 38 days to expire, 37, you'll have the March future trading at about a 2-point premium to VIX. Seems a little light given a VIX in the 11s. Meanwhile, the spread between March and April is almost 2 points. So I'm looking at either a March that's oversold or an April that's overbought or a little of both. And that's the paper we've seen as well. I continue to see people trying to sell calls in April, buy calls in March, or buy puts in April, sell puts in March. That has been the overwhelming trend that I have seen out of the marketplace. And there have been some big trades that have gone up reflecting that position.
Yeah, that is something we kind of noticed here as well. We're going to get to it in the term structure discussion. We'll get to it now. You're right. March versus April. It did seem to be something, I think, to use a technical term, a little bit wonky there. Hence, a lot of people obviously seeing the same thing and lighting up the tape this week with some options and futures trades around that. But you're right. Just something seemed off with that level between March and April. But again, it's a good recipe for some trading in an otherwise perhaps quiet volatility period. Same question for you, Mr. Rhodes. While you're convalescing over there in Casa Rhodes, what caught your eye this week from a volatility perspective?
Well, Mark and I are kind of looking at the same stuff. I was taking a look at the at-the-money straddle with SPX options that expire next Friday. You can buy the 2320 straddle, even if you pay the offer side on both the call and the put, for $18.70. That is less than a 1% move. So, I mean, over 4 days and an overnight. That's cheap. There's just no other way to put that. That's just extremely cheap across the board. Are you going to review the active strikes? Do we have time to do that? Because there's something I noted there that I thought was just awesome.
Maybe we can skip it if you want. You can just do the one that caught your eye.
You know what? The thing that I noticed is there's no 30s on there.
Yeah, you're right.
There are no 30s on there. And they always say if Villanova's on the cover of Sports Illustrated going into March Madness, there's no way they're going to win.
Mm-hmm.
And all that other kind of pop culture stuff. I'll bet you that if we go back and we find the last time that there were no 30s on the top 10 list, if ever, that we probably had a huge volatility spike. Shortly thereafter.
That's the contrarian.
That was the final step in complacency.
I don't know if it was that or if it was the time you finally turned to the dark side and started selling VIX in the crystal ball. One of those two things, maybe the combination thereof. That's what's going to do it. That's what's going to finally
wait for my guess now.
finally break. Yeah, you're right. You're going to be buying 17s now this week. Since we hit on the VIX options really quick. Do you want to do a weekly rundown? People will miss your music if we don't do it.
There is one thing I want to point out because I was focused on.
Hold on. Let me give you your music then, because we can't do without the music.
Now, Russell's weekly rundown.
All right, now it's appropriate. Go for it, sir.
Well, back in mid-January, I came across somebody buying the February 22nd, I believe the 13 puts. And they bought about 7,000 of them. They paid between 37 and 40 cents for them. It appears that they have been lightening up on that position. That open interest had stayed there around 7,000. Now I think it's down to around 2,000. And it looks like they've been selling those at 73 cents for the most part. Really nice short volatility trade.
Mm-hmm.
They ain't done.
No.
They're rolling out to the March 1st and paying 63 cents for those. So there, you always make fun of me, and there's a really good weekly observation. Somebody that called it right through most of February seems to think that it's going to continue into early March.
I mean, I tend to agree, but I nonetheless have lightened my put exposure, at least until we get some sort of with all the flow, I'm actually more interested in getting short in maybe those weeklies, or where that March 1 and March 8 are not that cheap relative to the standard March. So that might be a why those weeklies make some sense. And again, I like April as the play to play the market short. So does Smart Paper. So one trade I pointed out for TheStreet.com yesterday was you could buy the 15-12 put spread for $1.50. So that was yesterday. So you think about that. You need the VIX go to 13.5. So we're talking basically a 3-point rally for that trade to break even.
That's almost a 30% move. I know you like to phrase it that way.
Yes. You need a 30% move in the VIX. Jerk.
You just slapped Mark in the face, and I love it. That was quality. Really quickly here before we wrap up the vol view, we still are in earnings season. I'll do a really quick hit on some of the names that popped off this week. We saw some big ones. Disney. I think the trend overall, still the narrative really is underperformance from an earnings straddle / volatility perspective. Although there were a few shining stars this week in terms of outperformance. Disney, not really one of them. They were pricing in earlier this week. They were pricing in about a little over 3%. They moved a bit. They moved about a little over 2% as they got a little initial shine off their numbers, and then the market kind of took it out of them afterwards. Not feeling the love, particularly compared to last year, compared to the year of Star Wars returning and the toys and all the big numbers they had last year. A challenging year to live up for that. We also saw Twitter. Twitter is actually pricing in about 11%, and they're one of the few names that kind of outperform from a straddle / vol perspective. They dropped down about over 12%, about 12.5%. They opened up only down about 9%, but as the day went on, the sell-off continued. So premium buyers had an opportunity there to fare well. Activision, also one of the few names of the cycle this year, or this quarter anyway, that really outperforming, rallying to the upside. They were pricing in about 7.5%. In the after hours, they were at about 9 or so percent. Let's see. Intraday here, how they're looking right now, about 16.5%. So dramatically outperforming, shall we say here. So one of the few big winners for the premium buyers out there. People always ask us, should I buy, should I sell during earnings from a vol perspective? Well, here you go. Nice breakdown, at least for this quarter. Again, past performance not indicative of everything going forward. And I think we can skip Zynga. We can keep on rolling right on into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
Really quick before we hit the crystal ball predictions, so let's see. By the way, I'm trending not too bad here. We'll see. It'll be a knockdown drag out between me and the greasy meatball. But we asked you really quickly in our flash poll while our guest was on, what's your preferred VIX ETP? So pick your poison. We gave you VXX, obviously XIV. We threw a couple others in there too. I like TVIX, the much maligned TVIX, just to be silly. And we threw in another 47% right now, about half going for VXX. XIV was close second. Now it's only 16%, tied with TVIX actually. So some crazies of you out there still like TVIX, despite all the problems that one had, and 21% for other. So that's how you guys are breaking down out there in your volatility poison. But of course, in the crystal ball, this is where we attempt to predict. Oh, also I think we had someone in the chat room talking about he was a fan of VIX up, VIX down. Surprisingly, he's the one who was saying VIX up, VIX down was the chance that we had to really reach that holy grail. I may respectfully disagree, but again, you heard Greg say their product isn't really going to deliver that. It's going to get close, but it's not going to deliver that. So maybe technically you are correct that VIX up, VIX down was one of the few that was attempting to do that. We could sit here and argue all day about the efficacy of what they're delivering, but at the end of the day, maybe technically you're right, even though I may have to take the other side of that. Speaking of taking the other side, this is, of course, where we prognosticate where the VIX is going to be right now. This time next week at the close of the show, and last week we were all guessing all over the place. Russell, the buyer of VIX yet again, 1201. Mark joining me on the downside at the time. I think VIX was around 11.5 at the time, saying 1092. And I was here with a 10.5. So, our guest, Michael from Vol Surface and Exchange Capital Resources at 1134. So it looks like, Mark, this little bit of last minute spurt here in the VIX cash. It's a close one. I'm 0.27 away, and you are a little bit close, only 0.14 away. So I have to doff my cap to you, sir. You got it. Even though I was by the start of the show, I think I was almost exactly 10.5. So It's a bit of a mockery from me, but that said, sir, you get the privilege of going first. I gotta give it where it's due. So, or going first, or choose who you want to go first. Or actually, a little bit 1084. My quote might be delay here. So there you go. Even closer for yours. There you go. I'll give it to you. I already said you won. You don't need to rub it in, sir. What do you want?
I definitely want.
What do you want to do? Go first, or someone else go first?
I'll go first. I'm gonna say 1085.
Works once, right? Why not go again? Just go for it again. Hey, go big or go home. I like it. Now, Russell, I'm curious. You teased your pick, so I'm kind of curious. I got to go to you next. Are you going 9.5? Are you going to shock the world and go 17? What's your gut telling you?
I hit the mute button as I started talking. I don't know. I'm going to go with 1175 because I think none of you will go that high.
No, that's not as exciting as I thought you were going to go. I thought you were going to go somewhere crazy and esoteric and exotic. And you're right. We're pricing a little bit of a decline in the front month future out there, but getting out to March and beyond, April gets a little bit more wonky. Obviously, we're not going that far in our predictions. We're only going out a week. So who knows what tweets will be driving the market at this time next week. Of course, earnings season kind of winding down. A lot of other big drivers on the immediate near term to really drive a lot of vol in the space. So I'm not feeling really Russell's upside here. Mark going right where we are right now. So I have a choice of a little bit higher, or shall we say, I'm going to go dark side a little bit again. I kind of liked where I was this week, and it almost worked out until the last, 30 minutes or so when it was rudely taken from my grasp. But I think the second tilt at the windmill will be the charm. You know what? I'm going to go actually a little bit lower. I'm going to say 10.45 instead of 10.5. Give us a little bit of distance between me and the greasy meatball. All right, listeners, send us your own picks. Let us know what you think, or you could, if you want, mock our choices accordingly, as you are wont to do. Either way, that music means we've come to the end of yet another epic sojourn through the world of all things volatility. I want to, of course, thank our guest, Greg King from Volmax. So check them out, actually from RexShares, but their products is Volmax. So check them out, volmax.com. That's VOLMAXX.com. If you're interested in this proverbial holy grail or trying to get to it in the volatility space, these guys may interest you. And judging from your responses so far, I think that does interest you. So check that out. We'll have to have them on again down the road to checking out these products in a little bit more detail. All right, and Mr. Rhodes, what's cooking in the land of all things SIBO and indeed live vol?
I'm going to Mexico.
Uh-oh. You're not gonna be on the show next week, though. I'm guessing you're gonna be laid out again.
No, I'm going to an academic conference, and also speaking to a CFA society and doing a teach-in on volatility at a university in Mexico City next week. So I'll be dialing in from there.
I look forward to seeing how the Wi-Fi sounds in Mexico City, and how
they have guaranteed me it'll be good.
Oh. And how you sound after a week of quality water down there. I'm sure you're known to have a little bit of a gentle constitution, so hopefully you survive.
Yes, I do.
All right. And speaking of gentle constitutions, Mr. Meatball, what is cooking in the land of all things Option Pit? Andrew gave us a teaser the other day. He thought, as a result of one of our polls for actually this week, he thought maybe a long-term options trading strategy session was in order. So what's cooking in the land of Option Pit?
Yeah, well, just read our blog. Every day, read our blog. We've got some good stuff up there. On Fridays, I post a trade idea of the week. Read the blog, optionpit.com/blogs.
There you go, optionpit.com/blogs to check it out. And on behalf of Rhodes, on behalf of Mr. Rhodes, a.k.a. Russell, a.k.a. Mr. Corner Office, and our guest, Greg, and the Greasy Meatball, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course for joining us live in the chat. If you're in there, I hope to see you again in a little bit, actually half an hour exactly for TWIFO this week in Futures Options. Didn't get a chance on this program to get into a lot of commodity volatility. Don't worry, we'll get to it. Crude, gold, all that fun stuff. Maybe corn, who knows, live hogs. You never know what's going to hit it up on that program. Tune in 1:30 p.m. live here. You'll get to hear it for yourself, and we'll see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.